Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So in today's video, we're gonna be talking about your mortgage escrow account. What is an escrow account? What are the pros and cons of that? Should you have an escrow account when you get a mortgage and buy a home, or should you not? Stick around. In this video, I'm gonna teach you everything you need to know. Let's get into it. So listen, buying a house is a challenging thing. There are a lot of moving pieces. And one of those big moving pieces people are concerned about is their monthly mortgage payment. And as interest rates continue to come down, these monthly mortgage payments are getting more attainable for each individual person and family members. And that's why we're seeing more and more people start to flood back to the market, start to make offers on homes. But a lot of times, whether you're a first-time buyer or even a move-up buyer, there can be a little bit of confusion around a total mortgage payment. So today's video, I'm kind of going to break down a few simple things that you probably know, a couple things I definitely know you don't know, and maybe some secrets to help you get some financial relief and make your mortgage payment even cheaper. I like to start out with analogies. Anybody that has not been a homeowner before, I like to use buying a car as an easy analogy to kind of use as a point of reference. So when I'm talking through these things on home loans, specifically in this video about an escrow account, you will have something to reference to understand kind of how it works. So let's give an example really quick for a car, okay? Most people go to a car dealership or online or whatever they want to do and they buy a car. They say, hey, I'm gonna buy this car for $50,000. I'm going to get a auto note. That's a $50,000 note. It's a 5-year note, whatever the interest rate is, and the payments are X. We're just gonna use $800 for an example. So you're like, cool, I got my car payment is $800. But then you gotta call your insurance guy or girl and go, hey, here's the deal, man. I just bought a brand new Lexus. It's $50,000. This is the note holder. It's Chase Bank. They gave me a loan for this much, blah, 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 whatever. My monthly payment on the car is $800. I need some car insurance. And they go, okay, cool. Let me work up some numbers. Let me get it all squared over. They come back and say, hey, we got a deal. Your car insurance is $200 a month. You're like, great, give me the insurance. I'm gonna stick it in my glove box. I'm gonna pay it. I'm all good. So on your car, you have two things that really equal the total cost when it comes to a monthly payment. You have your car note, which is the money you're using from the bank to finance the actual car, of $800. Then you have your auto insurance policy, which is the insurance that you're paying to cover the car for replacement costs and wrecks and all that kind of stuff, whether it's full coverage, liability, but that totals $200. So your true total car payment / auto expenses from a monthly payment standpoint are $1,000, because you've got the car payment and then you've got the car insurance, and those two together are really your total. So remember that when we're walking through this video. So let's flip to the home side and talk about an escrow account and talk about your monthly payment and see how this is kind of similar but different, and how you have more choices and what you should and shouldn't do. And I'll tell you exactly what I would do if I was you, and also what I do on the current properties that I own. So a couple different things on this. So a mortgage payment always consists of 3 things, sometimes consists of 4, sometimes consists of a 5th variable. And people think that's a lot of stuff. It is a lot of stuff, but I want to explain to you what it is, and I'm going to explain to you how it works, okay? So very similar to buying the car, you as the consumer go to buy a house and you say, hey, I'm going to buy a $500,000 house. I'm going to put 10% down. I want to borrow $450,000 from the lender. The lender is going to give me a 30-year mortgage. Just for example purposes in this video, that lender gives me a 30-year home loan. It's 6%. My payment X. We're just going to make up a number, $2,500. Okay. All right, cool. So the mortgage payment on the mortgage only, just like the car payment on the car payment only, is $2,500. Okay. Now there are a few more things when buying a house that you have to get and that are included that are not included when you buy a car. The second thing is homeowner's insurance. So just like car insurance, you have to call your insurance guy and say, hey, I just bought a house. It's 1-2 Main Street. I love it. It's $500,000. We're closing on whatever date you want to close on, and say, like, work me up a policy. And they go, okay, great. Let me go check out the coverage. Let me make sure there's no crime in this area. There's been no leaks. Let me make sure you as a consumer don't have a bunch of claims behind you, blah, 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 blah. And they come back and say, cool, man, I got you a policy through Geico, Allstate, State Farm, whatever it is. And the total is this, but the month is going to be this. And they say, hey, the monthly amount's going to be $300. You're like, all right, cool. So my mortgage payment's $2,500. And then my homeowner's insurance is $300. So now I'm at $2,800. And then the third thing as a property owner that you're going to be responsible for are property taxes. Now, in another video, I discussed property taxes, how they're not all the same for everybody. Homestead, which is a primary home. If you're disabled and a vet, you get a disability break. If you're over 65, you get another break. But for purposes of this video, I'm going to do the generic homestead property tax deal that pretty much 95% of people need and are paying attention to this video on. So we've got the $2,500 mortgage payment. We've got the $300 a month homeowner's insurance payment. So now we're at $2,800. So how do property taxes work? Well, when you are shopping for a house, you don't really know what house you're going to buy. If you know the area, you can get a good estimate. I always use about 2.4% to run like a total cost analysis and an upfront payment scenario strategy to try to get it as close as I can. You know, I want to try to make sure that when I do the mortgage, the taxes, the insurance, all the fun stuff, that the payment I give the client ends up being 95% accurate. I like to get it within probably $100. So that way, as you're shopping and doing your thing, there's no big surprises. But back to property taxes, how does this work? So ultimately, whenever you go to buy a property, and we'll talk about new construction towards the end since a new build doesn't actually have a property on it, only has dirt and how that works. But let's assume you're buying a property that's, you know, been around for 5, 10, 15, 20 years. You go say, hey, I'm gonna buy 123 Main Street. We go to the county record. And then what happens is you pull up the public record on the county record, and that specific property will have a property tax certificate on it. It will say, hey, the taxes on this house, again, for simplistic purposes, are $12,000 a year. So you say, okay, great. Let me take that $12,000 that the property taxes are on this house and divide that by 12, and that'd be $1,000 a year. So now we got $2,500 for the mortgage. We got our $300 for our homeowner's insurance. We're at $2,800. And now we got the good old property taxes that we got to pay in conjunction with that on top of the $2,800. So now our total is what? $3,800. So what happens is your escrow account, it is a fancy word for taxes and insurance. Property taxes and insurance is X amount of dollars. So what happens in this scenario is if you want to include your taxes and insurance in the payment, or you want to say, nah, Brian, I'm good. I understand the total is $3,800, but this $300 a month for homeowners insurance and this $1,000 a month for the property taxes, I actually don't want that wrapped in my total payment. I don't want to pay you and your company and then have you and your company pay the insurance company the property taxes at the end of the year. I'm good. I'm going to do it on my own. I'm going to talk about here in a minute what loan program options give you that availability. But even if they give you the availability, is it good to actually take them out of the payment and manage them on your own? Or is it good to have the lender do it for you? Before we get into that, the fourth variable that I discuss with you guys that sometimes is on loans is what's called private mortgage insurance, or on an FHA loan, it's actually just called mortgage insurance. So there is a fourth variable, and I won't bore you with this, but outside of the mortgage payment, outside of the homeowner's insurance, outside of the property taxes, if you're doing a conventional loan with less than 15% down, you will have PMI, private mortgage insurance. It is just a fancy word for extra insurance that has to be added to your loan to get to a 20% equity position, because obviously these investors think people are high risk. And so why it's not very much money, it could be 50 bucks, 75 bucks, 100 bucks. That is a fourth piece that will be added to the bottom line if you do a conventional loan with less than 15% down. On an FHA loan, regardless of how much money you put down, there is monthly MI on the mortgage. It's not PMI because it's not private. It is just MI, which is mortgage insurance issued by HUD, and that is going to be on there for the life of the loan. That's an extra risk-based premium on there, and you will have to include that in conjunction with all the property taxes and the insurance. So there are some moving pieces on home loans. Again, in this video, you can see, well, how do I know if I'm going to have mortgage insurance and if I'm going to do a conventional loan, and what if I do an FHA loan and how do I get out of this? That's in another video in reference to a pre-approval and why you should do FHA over conventional and the pros and the cons on that. But for education purposes on this, we're just talking about what's all included in the payment. We're talking about the pros and cons of each type of loan. We're talking about what is a fourth and fifth thing on each type of loan, which of them can you get rid of in a short amount of time, and which of them are on there for a long period of time. So part two, now that I've broken down what all is included in the mortgage payment, which is the mortgage payment, which is the homeowner's insurance, which is the property taxes. And then sometimes you'll have PMI, private mortgage insurance, or MI, if you're doing an FHA loan, which is a fourth thing. Now the fifth thing on here, I'm just gonna throw in for giggles. Every now and then you will have a property that you buy in an HOA, a homeowners association. A lot of homeowners association have dues. Let's just pretend like those dues are $100 a month for maintenance, upkeep, whatever. That's a fifth thing that's included in the payment. Now, never, ever does a mortgage company include the monthly HOA dues and the total payment that you'll pay them. assume. They're going to include it in your debt to income ratio because obviously it's a legal binding debt. But whatever the HOA dues are, you want to include them mentally in the math so you know what you're responsible for. It's never required in the payment. You're going to pay the HOA dues directly. So you close on the home and figure out exactly how that HOA institution likes to be paid, but you'll pay them directly from A to B. It will never involve the mortgage company. So here's the fun part. Okay, Brian, I get it. Let's just go best case scenario. I got a mortgage payment. I got homeowner's insurance. I got property taxes. The question is, can you, should you, and will you be able to say, hey, I'm good. I don't want to have the mortgage, the insurance, and the property taxes all lumped into one, which is what most mortgage companies do, and they pay the lender directly every single month. And then what happens is at the end of the year, when the insurance bills are actually due and the property bills or tax bills are actually due, the lender, because they've been collecting that money from the consumer every single month, will take that money and they will cut a check to the county to pay the taxes in full, and they will cut a check to the county to pay the insurance in full. So here's where, being a certified planner, doing this for 20 years, I talk to people about not having an escrow account. Well, I think you should just pay the mortgage only. It makes it cheaper on you. You can take care of your taxes and your insurance on your own if you can, and here's why. So let's start with the if you can, okay? So if you're doing a jumbo loan with 10% down or more, you can. And again, it doesn't mean that you want to, but it means you can. If you're doing a conventional loan with at least 10% down or more, you can, meaning you have the option to do mortgage, taxes, and insurance all in the payment, or take them out and pay them on your own. If you're doing an FHA loan, you can never take the taxes and insurance out of the payment. You must pay the lender the mortgage, the taxes, the insurance, and the MI all together. No matter what, they take care of it for you at the end of the year. It's not even an option. And on VA loans for veterans, you can take the taxes and the insurance out as well, regardless of how much money you put down. So let's go into an example of where you can take them out of the equation, pay the mortgage only, pay the stuff on your own at the end of the year. And I want to talk about, for the last half of this video, why someone would do it, why someone wouldn't do it, and then what to be fearful about is if you don't do it through the bank and you do it on their own. We don't want you to get caught at the end of the year when the bills are due. You owe all this money and you haven't saved responsibly. So part one is, let's pretend like you put 10% down on a conventional loan. I'm running all your scenarios and I say, hey, your mortgage payment is $2,500. Your homeowner's insurance is $300. Your property taxes are $3,800. Your total all in for all three is obviously $3,800 bucks. But I'm gonna recommend to you that you take the taxes and insurance out of the equation. You pay the mortgage company directly and you just manage your own money and pay your tax bills and your insurance bills at the end of the year. Here's why. Two things. So the short answer is it will cut down on a lot of your closing costs as well. So from a closing cost standpoint, if they had to collect your prepaid escrow account, and in this scenario, your homeowner's insurance was $300 a month and your property taxes were $1,000 a month, they would collect 3 months of each to set up your prepaid escrow account. So 3 months at $1,000 a month would be $3,000 extra you have to deposit into the escrow account, and 3 months at $300 a month would be $900 you have to deposit extra in the escrow account. So that's $3,900 bucks. That's almost $4,000 that you as the consumer would be able to keep in your pocket from a closing cost standpoint when you go to close. So that's the short answer for part one. Now part two is the part where I really want to dig in deep and let people understand why I think it's best for you to take them out of the payment, out of the equation, and manage them on your own. So big banking institutions, any mortgage company, whenever you include your mortgage payment, your homeowner's insurance, and your property taxes all in one payment, you pay the mortgage directly. Those bills are not due till the end of the year. It changes in some counties and some states, but obviously here in Dallas, the tax records come out in October. You have until January of the next year to pay them. And obviously the insurance renews every year at the same time, same month that you bought the house. So what happens is, effectively, when you pay the lender, all three of them at one time in the lump sum payment, but maybe they're not due till the end of the year and there's 9 or 10 months to where they don't have to pay the bills for you. They take that money that you're paying them, in this scenario, $1,000 a month for the taxes, every month, $1,300 bucks. And they're gonna take your money and they're gonna go to the market and they're gonna hedge it and they're gonna use it and they're gonna basically take that money from you and every other customer. Think about that. You're paying them for 9, 10, 11 months at $1,300 a month. So at the end of the year, you've prepaid them $13,000, $14,000, $15,000 interest-free for bills that are not due until the end of the year. The bank has the money, the mortgage company has the money, on top of every other consumer that's got a mortgage with them in the United States, probably tens of thousands, and they are taking that interest-free money that the consumer is giving them because the bills aren't due until way more down the line, and they are putting that money in the market. They may be making 3%, 4%, 5%, 8%, 9%, who knows? But they are using your money on an interest-free loan to take that money, put it in the market, make as much money as they can, and then at the end of the year when those bills come due, they pay the bills for you directly because obviously you've been paying the mortgage company directly, and they're responsible by law to pay them when they come due. So what I prefer, if you're a responsible person, and if you're not, I'll show you how to be, is for you to say, no big deal, Brian, take the taxes and the insurance out of the equation. I will manage my own money and I will make money on my own money. Because I always say, hey, as the consumer, you're the client. I don't want the bank and the mortgage company making 7, 8, 9% on your money every single month. I'd rather you do it. So I show everybody, hey, if you want to do this equation, don't just take the taxes and the insurance out and then just hope at the end of the year you have the money saved and you can pay the bills in full. That's wrong. That's where people get in trouble. They don't save. They get really high and excited off a cheap mortgage payment, and then when the bills come due at the end of the year, they didn't save. I recommend doing the same thing that I do, which is whatever those taxes and insurance are. For an example here again, $1,300, you set up an auto draft account. An auto draft means your account, checking, savings, whatever it is, the same way as that you would pay the bank, but I want you to pay yourself, and I want you to put that money into an aggressive money market account. Set up whatever type of fund you want, LPL, Fidelity account, something in the market to where you can make 4, 5, 6, 7, 8% every single month. So what you're doing is you're not paying the bank the taxes and the insurance. They get an interest-free loan. They go take your money and play in the market and have fun with it and then pay the bills at the end of the year. I say, hey, you set up an auto draft for $1,300. You let that money go to this money market account every single month. You make 5, 6, 7, 8%. Why? Number one, I'd rather you manage your own money, make money on your own money. But number two, at the very end of the year, when those bills come due in full, you've been auto drafting all of that money every single month into a big old pot, which is a money market account. So you can pay the bills in full, manage your own money, control the narrative, and you've probably made interest on your own money as well, and better for you to make interest in the mortgage company. And finally, last but not least, escrow adjustments. So these are a huge problem when you include your taxes and insurance in the payment. So you buy the house right now in this year. What happens is historically, homes appreciate at about 4 or 5% a year. As property values go up, property taxes go up. As property values and taxes go up, homeowners insurance goes up. Why? Because it costs more to cover and replace a $525,000 house than it does a $500,000 house. Now, while these increases are small, what happens is when you, the homeowner, buy your house in 2024 or 2025, you're buying a house for this, the property taxes are this, the homeowner's insurance is this. A year from now, as that property continues to appreciate and the county resets it and says, hey, Mr. or Mrs. Jones, you bought your house for $500,000. Man, the market's really starting to boom with all these interest rates dropping. We've seen an increase in demand, competition, and pricing go up. So now your house is no longer worth $500,000, it's worth $550,000. So your first thought is, yay, I made $50,000 so far since I've been a homeowner. That's a great way to create wealth. That is a good thought. The downside to that is your property taxes on that $500,000 house are now property taxes on a $550,000 house. And while that increase may not be dramatic, it's enough to pay attention to, because if your property taxes were $1,000 a month, they may now go up to $1,100 a month. So now you owe an extra $100 for the property taxes in order to meet the requirements of the new county record and the higher price of the home. So why does this matter? Well, if you keep your taxes and insurance outside of your payment and the bill goes up because the property value increases, you can just pay the county directly, but your original mortgage payment stays fixed and it stays the same. If you include your taxes and insurance in it, and you go to year 2 or 3 or 4 or 5 and your house continues to appreciate, the property taxes that they originally set up and the insurance they originally set up was based on when you closed. It's not based on what it is next year or the next year or the next year. So what this results in is an escrow shortage. Oh my gosh, we no longer have enough money in our escrow account or in our taxes and insurance to pay what these new taxes are, because our value's going up so much, which is great, that we have to pay the extra. So the mortgage company will go in and say, hey, we're going to adjust your total payment, mortgage, taxes, and insurance from this to this, because what's happening is everything is going up and we have to increase it, so therefore you pay us enough, and therefore you cover the new amount, and therefore we have enough to pay it at the end of the year. And so they will go in at some certain point in time and do what's called an escrow analysis, and if they feel that the taxes and the insurance and all that kind of stuff are way behind or short, they will adjust the payment. That payment goes up sometimes anywhere from a couple $100 to $1,000, because it's not only what the new adjustment is, if there's anything in the arrears that are older from the previous year that are still owed, because obviously they were collecting taxes in the previous year and now we're in the new one, they'll do an escrow true up and a shortage, and sometimes it can really mess with the payment, $400, $500, $600, $700, and it puts you, the consumer, in a place to say, man, that's too much, you know, I can't afford it. There's a big payment spike, and so what do? The truth is you're stuck. You can't do anything. You just have to take the payment for what it is, because the lender had to pay the shortage when the property taxes went up because they weren't collecting enough from you, and it becomes this whole domino effect. So the takeaway on this is sometimes that happens. What I prefer is the person just to have the mortgage payment only, and in the event the property taxes go up a couple $100 a year or $500 a year, you know, whatever it is, you can fight that directly with the county, or maybe put that extra money on a credit card, or even protest with the county to try to get the taxes back down. But you fight and pay all that outside of dealing with the mortgage company directly. You do it on your own, and therefore it never gets in the way of the actual payment, and it will never adjust. Now again, like we talked about in the beginning, FHA loans and things like that, they don't allow for this option because it's just part of the rules. So you have to be very, very mindful of all the escrow adjustments and the property taxes and everything, and all the increases in the future, because obviously it will affect the payment. It can put people in a tough position. But my takeaway on this is, when you are given the option on an escrow account to include or not include in the payment, I recommend not including. You can manage your own money, make money on your own money. Don't have to worry about a payment spike on an escrow shortage, and it will save you a couple $1,000s on the closing costs when you go to close on the original home. So listen, hopefully you found this video useful. If you did, do me a favor, like, comment, subscribe, even share this to somebody that you know that could benefit from this information. And if you want to have a conversation around buying a house, refinancing a house, or just what's going on with your current pre-approval process, do us a favor, call us, email us, text us. We're always here for you. Until next time, stay tuned.